as the title of my presentation says, I mean, I think we got a very good setup here. I mean, it's the market, always anything can happen, but it looks to me like we're going to have a pretty good time here for the next few months. I don't see anything obvious that's going to derail things. And, you know, it's interesting because it wasn't very long ago, in fact, it was about a week ago, when everybody was hating on gold and there's no catalyst, there's nothing going to turn around. I've been saying to subscribers for a little while now that I thought the bottom, or a bottom, I suppose, would be the taper announcement. And the reason for that really was that through the last 3 or 4 months, really ever since the FOMC members started talking taper at every opportunity, every time a macro reading came out, or there's anything that the market could construe as a reason to harden their decision to taper, you would see a big dump in the gold price, and we saw like 5 of those in the last 3 months. You know, one of them was one of the inflation readings. One of them was a non-farm payroll. There were 3 or 4 different things, and there'd been enough of that I just, you know, to my mind, I felt it pretty much had to be priced in. I mean, I know there's a certain subset of gold bugs that are like, there's never going to be taper, there's never going to be rate increases, but I think the market in general and the majority of traders in the gold market were resigned to the fact, 1, that there was going to be a taper announcement, and 2, that it was going to be this month, and in fact it was. You know, now that I've seen gold not only react well to that, it reacted very well to the non-farm payrolls last Friday, which could have gone the other way for sure, because the consensus was 400, it came in at 550. Any number of months earlier this year, when you saw that kind of a beat on the payroll number, gold got whacked. It basically went up this time. Even the day of the taper announcement, it actually dropped before the taper because of some PMI numbers. The taper announcement was actually after it had come off the bottom, and it went up $15 after the taper was announced. So I think right now we're very well set up. I'm very happy to see the way gold's trading. It's trading in a market where it should actually have more headwinds than it does right now. I mean, if you take a look at what, I'm just going to move to the next slide here, just so we've got our timelines. I've got the arrow there pointing, that's basically when the taper announcement was, where I've got that arrow going. And interestingly enough, the taper announcement and then PPI numbers a couple of days ago, CPI numbers yesterday, you take all of those numbers in the market of September or August or March, gold would have gotten whacked on all of those days. And in fact, gold isn't just trading well because the things it often trades against trade badly. And to give you an example, there's 2 charts here on top of each other. The top one's a gold chart, bottom one's a US dollar chart. It's a truism that gold trades against the dollar, it trades as a currency. A lot of people in the gold market, the main reason for gold doing anything is US dollar. I'm not one of those people. I don't think that's the main reason. I've pointed out for years that the correlation between gold and the dollar actually shifts all the time. And this chart's a good example. If you look at sort of the middle of this year, there's a very obvious negative correlation between gold and the US dollar there. US dollar's dropping, gold's going up. Dollar goes back up, gold drops. If you look at the right side of the chart, there's actually not much correlation. And in fact, yesterday, the dollar was really, really strong. The dollar had the best day it's had for, you know, months and months and months. And gold went up $20 with it. I mean, that's a very good sign. When I see that, when I see gold starting to move and I see it moving with the dollar, with yields, to me, that's a very, very bullish sign. Same thing goes here. This is sort of reprise of the previous one, except this one, instead of being the dollar on the bottom, it's TNX, the 10-year yield. And again, it's a little more subtle with the yield chart because it's real yields that matter, not nominal ones, and these are nominal yields. But you can see it, you know, generally the negative correlation when yields were rising early this year, gold was dropping, vice versa through the spring. But again, if you look at the right side of the chart, it didn't circle it, but you can see, you know, when CPI came out, when PPI and then CPI came out, it was pretty strong sell off for bonds. I mean, the 10-year yield went up about 12 basis points in like half an hour. And gold basically went right up with it. It really didn't hold the gold back at all. And on any given day before 2 weeks ago, gold would have just gotten creamed if the bond market had done that. You would have seen gold drop 50, 60 bucks easily. So all of these things these are all very, very positive signs. And this is I couldn't find a short-term chart that I like to look at, so I kind of had to fall back on a long-term one. Again, this is like a 10-year chart. Top one's gold. Bottom one is a 10-year TIPS yield. The TIPS yield is essentially it's the equivalent of a bet on real interest rates as opposed to nominal interest rates. That's why you see it go negative in some spots. And if you look on the right side of the chart there is a pretty strong dip. And the reason for that dip, basically real yields are made up of two components. One is a nominal yield, the other is the inflation rate. So what happened a couple of days ago was CPI printed really strong, 0.9% month over month. And again, normally the market would have just shit the bed with that kind of a reading. And the reason why it didn't, and the reason why gold held up this time, was because I think bond traders and probably gold traders both have kind of shifted their mindset to, earlier this year it was the taper's coming, inflation's going up, the Fed doesn't have any choice, there's going to be rate increase after rate increase after rate increase, and people were thinking that, and they're buying dollars, selling bonds, selling gold. I think it's got to the point now where you're still seeing them sell bonds because bond traders are definitely starting to take the, long-term inflation as opposed to temporary inflation more seriously. But I think they're also saying to themselves now, there's so much differential between nominal rates and inflation now, there is no way in hell the Fed gets ahead of this. They cannot get ahead of this. They're not taking rates to 6 or 7%. The Wall Street would implode if they did that. And I think they gave that message in the last Fed meeting on the 3rd of November when instead of focusing on inflation, they did the usual, yeah, we think it's transitory. I think it's partially transitory too. I think inflation will ease off a bit next year. But what they really focused on was their unemployment target. And they reiterated several times, our unemployment rate target is 2%, which I think is the FOMC saying we're going to have to be dragged kicking and screaming into raising rates next year. And interestingly, right now, these I guess they look big enough on here. There's a couple of things that I want to point out here. This is a CPI reading that really helped really move things. Part of the reason why bond traders are getting paranoid is the chart on the left. Basically, that is the percentage of this. Every CPI number is made up of about 28 components. That is basically what percentage of the components came in above 4% inflation. So if you see the way that really ramped up in the last 4 or 5 months, basically that means inflation's broadening. It's not just used cars. It's not just shipping containers. It's broadened out. So it's a lot more likely that at least some of this is not going to be transitory. It's going to be here for a while. And you can see the way that bond traders reacted to that change. The bottom chart on the left, that's basically a calculation from the bond market that tells you what bond traders are pricing in, what they think the Fed's going to do next year. Right now, they're pricing in like over 80% odds of 3 rate increases next year from the Fed. The Fed is not talking about 3 rate increases. There's nobody on the FOMC saying we're going to raise rates 3 times next year. And ironically, that's probably another tailwind actually for the gold market, because bond traders right now are probably being overly hawkish. Certainly when I listened to Jay Powell on November 3rd, he was going out of his way to say, look, the metric I'm looking at is 2% unemployment, and we're nowhere near 2% unemployment in the States. And he basically also said we aren't even thinking about raising rates until we finish the taper, which is the middle of next year. So I think the Fed is trying to send the message there aren't going to be more than 1 or 2 rate increases. The bond market is already pricing in 3. That actually, to my mind, increases the odds that you've got this buffer that's going to help keep the real interest rates lower for longer. And for gold and for commodities in general, that's the name of the game for me. Negative real interest rates, stuff goes up. It's not. There's no need to overthink it. So basically, none of what's on this page is going to be new to you guys, I don't think. They've broken out decisively. Every chart. I'm not really a chart guy. Every chart guy I know, it's above the levels any of them are using as a downtrend line. That was an 18-month downtrend. It's very decisively broken out through that. Are we happy yet? Of course not. We're gold investors. We're never happy. We're all masochists. I think what we'd all like to see, and I'm hoping we will see, I'm not saying it'll happen tomorrow or next week, is gold getting back to that sort of 1900, 1920 level, because that's like a really done deal, definitive breakout above last year's levels. And if it goes through that, I don't even know what the target is after that, but it's somewhere probably well above 2,000. And keep in mind, I'm not a gold bug. I'm just telling you what the chart says to me. And again, the driver here is real interest rates, not nominal interest rates, real inflation-adjusted interest rates. But keep in mind that bond traders and gold traders, they don't just look at absolute levels, they look at changes. And the real interest rate can move up and down based on what the inflation curve is doing and what CPI is doing. If CPI drops 1%, real yields go up 1% because that's all it is. It's nominal yields minus inflation. So that is going to bounce around. So I'm not saying this is going to be like a straight shot upwards. I'm sure we're going to have drawdowns now and then when you see real rates bounce up because of what CPI is doing. But I think we've got a very nice opening for a fairly long, long-term rise here. I mean, I could see this going through year end, and I think if it gets through year end, it probably goes through Q1 as well, because Q1's generally good for these kind of stocks anyway. And gold producers, I've had a lot of people ask me, like, why aren't the gold miners trading better? I mean, they're starting to trade better now, but the truth of the matter is, most of them didn't put up great Q3 numbers. By and large, they came in a little bit under consensus. And the main reason or the main excuse, whatever you want to call it, that they gave was cost, because inflation affects them like anybody else. And one big mover in the last quarter, of course, was energy prices. And mining is very, very energy intensive. So when oil goes up 30 or 40 bucks a barrel, it hurts if you're a miner, because it's a very, very energy intensive business. So that raised their costs. But I think we're probably through the worst of that. Gold looks like it's heading through 1900 again. I would think Q4 is going to be pretty good. And I don't think a lot of the generalists that, they don't really look at the mining sector. And gold miners have a well-earned, let's be honest, reputation for doing deals at the top of markets and having horrible balance sheets and stuff, but that's not really the case anymore. Gold miners as a group, I think, probably have the best free cash flow of any sector in the market right now. Any sector in the market. I think financials might be better, banks, that's it. All the other sectors everybody's going crazy for, they look like crap compared to the gold sector when it comes to free cash flow. It's just most of the market hasn't figured that out yet. But I think if these guys, and most of them are racking up a lot of cash, so I think you'll start seeing all of them doing things like raising dividends and stuff. And that's, I think, what will bring in the attention and get more of the generalists who come in looking for yield. And, ironically, we've all been moaning about assay labs all year, all last year, all this year, hopefully not all next year. I mean, everybody's been in assay lab hell. I guarantee you every guy at this table was talking about doing MIF a couple of months ago, firmly under the belief that he'd have a whole raft of drill results to wave around. Not so much, just didn't happen. But ironically, that may actually work in our favor for once, because we're actually getting a big sentiment improvement ahead of the assays this time, because we're only going to start seeing guys putting out assays from summer programs in the next couple of weeks. So weirdly, as weird as it sounds, I think the timing's actually going to work for us this time, because we're getting a sentiment shift, and then we're going to, all of those assays that normally would have been September to December are now November to April. So that's the other reason why I think we probably got a pretty decent run ahead of us. That slide should not even be there anymore. This is just, I'm not going to spend a huge amount of time on base metals, even though a lot of the guys sitting to my right are base metals. Sorry, boys. I was concerned, and I'm still a bit concerned about China. China's just such an enigma when it comes to economic. You can't really trust any economic numbers out of there. Xi's got the place completely under control. He's much more autocratic than, I mean, Jesus, I don't think Mao was as autocratic as Xi is. And Xi is doing what I think is the right things and what he has to do. He is serious about trying to deal with things like pollution. I think he's serious about trying to deal with the debt bubble, although I don't think he's figured out how to do it. I mean, we've all seen these scares, this property developer, that property developer, missing bond payments. There's going to be a bunch of bankruptcies, but so far, it's really not impacting metals that much. I mean, China's kind of the 800-pound gorilla when it comes to base metals. And really, you look at these 4 charts, these charts are as of yesterday. There really wasn't much pullback. I mean, zinc had a bit of one, but that was just a spike. I mean, that's what a chart does when it spikes. But you look at copper. I mean, I was getting nervous and copper pulled back a couple of months ago, but it's pretty much back up near its high. Anything that's electrification metal or a battery metal, I mean, nickel's strong. And really, at the end of the day, it comes down to the fact that we're in the era of endless permitting cycles, ESG, NIMBY, which has always been there, but there's a lot more NIMBY to go around than there used to be. You put all those things together, and it simply takes a longer and longer and longer to get something through development and into production. We're simply not in a world anymore where miners can flip a switch. And interestingly, even with the other side of the supply constraints that we've had this year across all industries, and one big constraint there has been in China, there's been 2 things that they've been doing. One is pollution. There's some of the smelters are just so nasty, they've just ordered them closed. But even a lot of the other ones have had occasional temporary shutdowns because they're basically against the wall when it comes to the capacity of their grid. They just can't build power stations fast enough. So that means even though you still got, say, copper miners, zinc miners, you do have a bottleneck now at the smelter level, and you've got a bottleneck at the shipping level. So you take those things together, and I didn't bother putting them up, but if you go and pull up the warehouse inventory charts for all of those metals, they're all going upper left, lower right. None of them have bottomed out. They continue to drop. And that's the kind of background where I don't really see a lot of weakness in base metals anytime soon, unless something really goes sideways with the economy in general. There's simply too much supply constraint. There's too little inventory. I think there's a lot of people in all of these metal markets that are going to be quite happy to buy the dip, if anything's dip, because nobody's really got anything in their warehouses. So this is a very, very busy slide, but it's just a summation slide. I'm just going to run through it. Nothing's for sure. Obviously, the market's a market. Things can always go sideways. But really, this is as good a setup as we've had for, I said early last year, but it's probably been several years, and you can make the argument this is the best environment we've had in several years. Have at it. I think we're going to have a very good run here for the next few months. I don't think we're seeing much generalist money yet. I haven't seen very many. There's none of the metals funds or the gold funds. None of them are talking about enlarged assets under management yet. There was a lot of drawdown earlier this year, all the gold funds and stuff. I don't think we've seen new money come in yet, but we will. I think that's going to happen very quickly now that things have really started to move. But the generalist money, they tend to be, they're by the top guys. When does generalists come into a metals market? Generally, it's when it hits an all-time high. That's just how they look at the world. But happily for us, you've got guys that'll pay $850 million for a emoji. So, who the hell cares if you throw $50 million at a gold stock? Cheap. I do think the broadening of inflation is real. I mean, the numbers are there, but I'm not really an inflationista. I do think a lot of it's going to moderate. I think a lot of this is supply chain issues. They're not getting fixed fast, but ultimately they will get fixed. So, I mean, I'll be surprised if we don't see inflation sort of draw down back to, say, the 3 or 4% level by the time we're well into next year. The consumer confidence is doing a lot better than I thought it would. I think there's 2 things for that. Lots of people have been getting checks from the government here, there, and everywhere. Plus, Wall Street is so strong, and Wall Street and the wealth effect that you get from high equity prices, that has a very direct correlation to high consumer confidence. Consumer confidence is high right now. Most of the recent surveys I've seen, buying expectations were, I was surprised how strong they were. How many people are planning to buy, new appliances, new houses, new cars, new whatever. But just keep in mind with that, though, is that's something that turns on a dime. I mean, the last time I saw numbers like this was before the shit hit the fan in 2008. In that case, it was real estate prices that was creating the wealth effect. And this time it's stocks and crypto, I guess, doing it. But I don't see, that said, I don't see an obvious bear market catalyst out there. There's nothing out there that's freaking me out. The one thing I am keeping half an eye on, I'm not an inflationista, which means I'm not a stagflationista either. But that is something we're going to have to keep an eye on going forward. I mean, yeah, a lot of industry groups, there's a lot of hand-wringing and wailing and moaning about wage increases and stuff. But if you look at where the CPI has done the last few months, wage increases are not getting ahead of CPI. I mean, people's real purchasing power is dropping, your average wage earner. And you go back to the 70s and you think about the stagflation and these short, choppy cycles and overall low growth. That's really what created it was the average person couldn't get ahead of the inflation and their purchasing power just got worse year after year after year. And that's a lot of what drove, the term growth during that period being like 2.5% instead of 4 or 4.5%. That's something we have to keep an eye on. Because I'm not that worried about long-term inflation, I don't really expect it, but it's something we all have to keep half an eye on. But then the one thing with that is if we do go into the stagflation, a lot of people are talking about, those aren't short cycles. We'll get lots of notice. We'll see it happening all the way through. It'll develop over 4 or 5 quarters, so it won't be something where you wake up one day and it's happened. Like we'll all see it coming if that's what it is. But even if that happens, if you go back to the 70s, I was actually alive then, unlike all of you, and actually working at mine sites. That was a pretty good decade for commodities by and large, because you also had that negative interest rate regime. I mean, the 70s was of course when gold really had its first big bull market, but even base metals did quite well then. Commodities in general, oil obviously did fantastic in the 70s. So even if that's what we get, I think we're going to be one of the premier sectors over the next few years. But shorter term, I just think we're going to have a lot of fun. And the next 2 months, 4 months, 5 months, we're all going to be making pretty good money. So we should just enjoy it and pat ourselves on the back for being clever enough not to get out when everything fell apart. So yay us.